Hi everyone, and welcome to our new research video that I consider to be really important. Before I explain why, I have to remind you that this video is not investment advice, and if I'm gonna speak about specific financial instruments like futures, spreads, ETFs, options and others, it is always just for educational purposes. I will not delve into detailed explanation because I already did so in the Substack article we released in parallel with this video. So you already have this in your inbox or received a notification if you have the Substack app installed on your phone or tablet and you're subscribed to our Substack channel. But just to make the long story short, if you follow our research or follow us on Twitter, you already know that we've been rather passive this year. Basically, sometime in spring this year, we identified the US dollar to be absolutely the best opportunity from the risk-reward perspective. And that has been true till this day. Of course, we alerted you to a few specific ways how to trade this opportunity. For example, it was the short on Chinese yuan, which is long on this chart. And you can see the tremendous upside since then. Or it was short on the Canadian dollar, which also turned out to be fantastic. And last but not least, it was short on euro and the Polish zloty. And we basically nailed the top on euro. So all these opportunities, all these ideas turned out to be spectacularly successful. But I am personally not interested in these speculations. So when I got back to markets at the beginning of this year, I started disclosing my moves to you, to our premium users. And I basically told you that I got long the US dollar through T-bills ETF. And remember, being long the dollar means a totally different thing for a European like myself compared to an American. So it is highly speculative to me, for me to be long the US dollar. And it has worked really well for me. And right now, I have finally identified an opportunity which has such an interesting risk reward that it forced me to get out of the dollar, at least partially, because I still hold the majority of my assets in the dollar, but at least partially I was forced to open a new position on this opportunity. To get straight to the point, I opened a long position in emerging market equities by buying the EEM ETF this Friday just before the close. Let's take a look at these equities. We have one incredibly helpful contract in the SpreadCharts app under the MME ticker, which stands for MSCI Emerging Markets Index Futures. And the point is, these futures track exactly the same index as the EEM ETF. So I personally use this data just for analytical purposes because I don't have a margin account, so I cannot trade futures. But of course, someone else might even consider trading these futures directly because they are very liquid. But for me, I just use it to analyze the data instead of the ETF. It might have also some advantages, such as the dividends. I mean, these futures are less distorted by dividends. Of course, it has, or its term structure is positively sloped, and its slope is also affected by dividends. But the distortion is in my opinion, much less severe compared to the ETF because you can pick the front contract such as this one, and this is less affected by the dividends compared to the EEM ETF, where the dividends are paid and therefore accumulated in price twice a year. But let's focus on the chart now. I will zoom out so that you can see that these equities are quite oversold because they have been in a bear market since the peak in February 2021. So that's good because they offer good value. And not just from technical, but also from fundamental perspective, their valuation ratios are much better compared to US stocks. So the emerging market equities are cheap. But just because something is cheap doesn't mean it has to be a good opportunity. And this long-term chart is the proof of this statement because, as you can see, these emerging market stocks basically went nowhere for the entire decade. So yes, they are cheap, and they have been cheap for the entire decade without doing anything. So they have not been exactly a good investment, especially compared to the US stocks. And now you're probably asking what has changed? Why do I think these stocks have bottomed and their prices will go up? Well, first of all, I think this index has not bottomed yet. Actually, I think its price will go even lower. And the reason has a lot to do with my overall macro outlook. If you follow our research, especially our quarterly macro outlooks, you know that I've been bullish the dollar for quite some time, and I still think its price will go even higher. My target, at least the first target, is somewhere around 109, maybe somewhere between 109, 110, but I want to see the dollar index to go at least to 109 before it turns lower and corrects. And we are still far from this target. There is still a lot of upside left. Moreover, when I take a look at the positioning data, the commitments of traders data, yes, the dollar is no longer oversold like it was during the summer, but it is also not overbought. The positioning is perfectly neutral. And I would prefer to see overbought conditions before being convinced that at least a local top is in on the dollar. And if you are familiar with behavior of emerging markets, you know that their equities are most of the time inversely correlated to the dollar. So as I expect the dollar to go higher, that would be negative for EM stocks. And it's not just about the dollar, it has a lot to do with the bond market. Basically, the dollar will probably remain strong as long as bonds continue to move down. And this is unlikely to change before the Federal Reserve alters their monetary policy in a decisive way, either because of some geopolitical factors or most likely because the US economy slows down materially. And if you watched our last quarterly macro outlook, you know that we are not there yet. There is probably still more downside for bonds and upside for the dollar. This also fits perfectly to the price action in the US stock market and the volatility measured by VIX futures. Yes, the market is oversold. It has dropped significantly since its peak in July. It's down by 10%, and that's a major correction. The volatility increased accordingly, and I will switch to the front contract, which will be even better for what I want to describe. So it has increased, also the volatility has increased, and the price action in VIX futures is it's kind of sticky. I mean, the volatility is refusing to drop, and that is not great for equities. It is actually bearish. But on the other hand, despite being elevated, there was no spike that would mark the actual panic in the markets. While there is no guarantee we will get such a spike, it would create much more favorable conditions for a sustainable medium-term bottom in the stock market. So I would be much more happy buying stocks if we get such a spike. Now, I bet you are thinking this doesn't make sense. Why am I buying the emerging markets index if I think it will continue to move down? Well, if you follow me for some time, you know that I trade the data, not my opinions. And the data speaks clearly. I created a simple Bayesian model for the US stock market back in 2015, and it has helped me identify interesting medium-term opportunities in this market since then. I later created similar models for other major asset classes, namely the emerging markets index, oil or energy in general, and precious metals, specifically gold and silver. And this week, the Bayesian model for the EM equities issued a long signal with full strength. There was a weak long signal last week, but this week it turned into a full long signal. Moreover, the model for the US stock market issued a long signal this Friday too. So I take this as a confirmation that there might be a turnaround in the equities. I don't know if it will be just a bounce or if it is a medium-term signal and the equities will go down first. But I frankly don't care. As I told you, I follow the data, and the data for me is my model. Of course, I can go through all the data that serve as an input into the model. It is not too many time series, but I don't want this video to have an hour or so. But if you follow our macro outlooks, you know what data we watch. So if you go through the data yourself, you will get a good idea why there was a change in the model's output. One thing I want to mention is that the breadth has arguably improved because the US equities have been selling off since this summer, but the breadth has been rather weak because the few of the largest stocks, mostly technology stocks, have been holding the entire market while the rest of the market was getting sold. And now we are finally witnessing sell-off even in these large, really large companies. And that's the reason for the improvement in breadth, because the rest of the market is already oversold. So it is not falling as much as the top stocks. And that's probably maybe the reason why we might be close to at least a bounce, if not a medium-term bottom in the stock market. But as I told you, I personally think we will drop even lower. But the data, or at least my model, disagrees with me. And as I told you, I prefer to stick with the data rather than my opinions. Now you might ask why the emerging markets specifically rather than the US stock market. Well, I will give you two reasons. One is pretty subjective, so you can ignore it, and it has a lot to do with China. Chinese stocks have the largest weight in the MSCI Emerging Markets Index, specifically something around 30%. Moreover, there are other countries in the index from other Asian countries with large weight in the index, like the Taiwanese equities that trade very similar to the mainland equities, and also countries like Korea and India that also are positively correlated with the Chinese stock market. So the index is dominated by Asian equities. And I mentioned China, which has undergone a pretty serious bear market. And the Chinese government is trying to prop up their economy and even the stock market specifically. But the measures they have implemented so far have proven to be insufficient for the task. That's not so surprising because they are restricted by the Chinese yuan, by the Chinese currency, because they cannot afford to devalue the yuan too much because that could trigger a capital flight from the country. I personally think they are withholding stronger measures like larger stimulus packages or monetary measures until the Federal Reserve makes the turnaround in their policy, until the pivot. And that won't happen until the bond market bottoms out. So maybe we will have to wait a few more weeks or months, who knows. But the data is clearly in favor of at least a local bottom in the emerging markets index. The second reason why I picked the emerging markets rather than the US markets is pretty objective. And I will show you this chart, which is basically the ratio between the emerging markets index, specifically the futures on the emerging markets index, and developed markets index. We have both data or data for both futures in our app, and both are pretty liquid. And it is once again a very insightful piece of data. I will zoom out and show you 3 reasons actually why I consider the EM equities to be more appealing in the current situation. First of all, I will zoom out even further. First of all, the ratio reached support and bounced off the support around 0.45, which is a major level because it is the same level where the ratio bottomed in 2015 and 2016, which were coincidentally major bottoms for the emerging market equities and even more specifically the Chinese equities, because the sell-off back in 2015 was mainly triggered by the situation in China. So this is quite important, but it's not all. The second interesting coincidence is that the ratio has broken out from this falling trend line. The price action is rather subtle for now, but there is no doubt this is a breakout. So that's the second reason. And now I will zoom in and maybe delete these, erase these 2 trend lines and focus just on the short-term price action, because I consider it to be really interesting. First of all, the volatility has died out in this ratio. That's a good thing, because that means larger move is probably ahead of us. And I think the consolidation is pretty constructive, and the break higher is more likely rather than the break lower. So these are the 3 reasons, technical reasons, but objective reasons why I prefer the emerging markets index. So that's all about the opportunity in the emerging markets index. But there is one more thing. I actually opened 2 positions this Friday, not 1. And the second position was related to emerging markets, to be honest, because it was a position in Brazilian equities in the EWZ ETF. And what's the reason for Brazil? Well, actually, I liked Brazil for quite some time. I even commented on our Twitter about Brazil this summer, but it was not optimistic, quite contrary. I was making fun of the people who were excited about Brazil back then, because I highlighted the speculative flaws to Brazilian assets, specifically the inflows into Brazilian real, the currency, the Brazilian currency. And I asked a rhetorical question, how sustainable it is. And of course, I meant that it is not sustainable. Which turned out to be correct, because shortly after the Brazilian stocks and also the real turned down and started correcting. So a month later, I once again asked what was the reason for the excitement a month ago, whether it was the incredible Brazilian economy or just a cheap US dollar. So that was just a quick comment on Twitter. Now, I was making fun of those people who were so excited about Brazil back this summer. But I do not disagree with them. I think they were actually right. Just their timing was wrong. So you can browse all the Twitter feeds of major FinTwit gurus from this summer, and you will find out why Brazil is so interesting. They have a very strong energy production, and they are self-sufficient in many ways. And yeah, I think the composition of their economy is really interesting for the upcoming period. So yeah, that's the reason I like Brazil. And the reason why I like Brazil right now is because the flows turned around, and right now the Brazilian assets, for example, the Brazilian real, are oversold. Here you can see the commitments of traders data for the Brazilian currency, and I think the net traders indicator for large speculators is the most helpful. You can see how incredibly overbought the real was in July, but this is no longer true. The positioning is back to neutral or maybe even slightly oversold, and that's the reason why I became interested in Brazilian equities. Now, don't take me wrong, the main reason I bought the Brazilian ETF is because of the long signal for the emerging markets index. So without the signal, I would definitely not buy Brazil. Because Brazil is emerging market too, so it perfectly fits the narrative. However, as I explained, the EEM ETF for the emerging markets index is dominated by Asian equities. Brazil actually has a small weight in the index, so that's the reason why I opened a separate position with equal size, the same allocation. I used my one allocation unit for each of those two positions. So that's the reason why I opened additional position separately in the Brazilian equities, in the Brazilian ETF. But despite my desire to get exposure to Brazil, my timing may turn out to be wrong because once again, I still think the US dollar has not bottomed yet, and this is somewhat confirmed by the price action in the real because it has turned lower from this falling trend line, this resistance, which is also close to the resistance, or at least a major level around 0.2, and these two supports, now resistances around here. So maybe it will drop even lower. That would not be surprising. Actually, it would be aligned with my own opinion. But once again, I decided to follow the data, which has turned positive for the emerging markets. And like I said, Brazil is an emerging market too. So I hope it will follow my model and not my opinions. Before I say goodbye, I want to stress one important thing. The only purpose of our premium research is to alert you to potentially interesting opportunities in the markets. Nothing more. The reason I disclose my own personal positions is because I got back to markets at the beginning of this year, and although I have no legal obligation for these disclosures, I consider it to be the right thing, to be transparent. So when I talk about opportunities or assets that I personally hold, I think it's fair to disclose that. That doesn't mean you have to follow me or follow what I'm doing. I actually think that would be pretty unwise. You do not know my strategy nor my allocation and risk management. I can change my positioning unexpectedly. I can even close the entire position a week from now, and I will not notify you about it because, as I told you, the purpose of this research is not disclosure of my positioning. That's just a bonus, a fair thing to do. But I won't be making a video about changing my positioning. That would not make sense. The purpose is to alert you to the opportunity, which is something I've done so today, and it's your responsibility to decide if this opportunity is interesting to you. And if you trade the opportunity, it's entirely your responsibility to manage it according to your requirements. Now that this is clear, I can tell you that I personally hope this will turn out to be at least a medium-term opportunity, because I'm really not interested in short-term speculation anymore. But of course, if the data, specifically if my model shows that situation has changed dramatically, specifically if it issues a full short signal, I will, without any doubt, at least reduce the position or maybe even close it entirely. This will depend on the data, and the current markets can be sometimes really surprising. And that's finally all for today. Thank you for watching us, and see you next time.